If the company does the same thing, but it does 85, then you see for a net income position. What's up, everybody? This is Jat from the Bliss Life. It is the 26th of February 2022, and I am going to review the Q4 2021 financial statements for Palantir Technologies. This is super important to do because if you're an investor, you need to know what's going on in the company. Now, the key takeaway is all going to happen at the end, so you need to be patient. I'm going to run through all of this. It's going to be a 30 to 45 minute video, so I need your focus, I need your attention. We're going to run through the details. I'm going to share my thoughts, and then we'll do a quick recap at the end. If you want to just go straight to the recap, I'll definitely put a chapter at the end so we can get there, or you can get there. So let's get started. Palantir Technologies consolidated balance sheet here really showcases that cash balance has grown from 2 billion to 2.3. That's good. Check. AR has grown a little bit. Check. So business is good. Marketable securities. So these are your SPACs and their other investments. Good. Prepaids are going up. Almost doubled. So, when I see prepaids going up, kind of makes me feel a bit uncomfortable because it could mean that Palantir, Palantir is putting cash with suppliers when it could be keeping that cash for itself and doing other things. So it really makes me wonder what has been prepaid and why did it double. But I'm sure it's not material enough that I don't think they have their own note explaining it, but we'll look into that. It could be for tax purposes and they're treating it as a prepaid in the meantime, because you do have to send the government cash when you owe them taxes, but it's not final yet. Property and equipment, 31 million, relatively stable. Restricted cash, non-current, so they have some cash here. It went down, the restricted cash. Okay. Operating lease, still the same. Other assets, a bit down. Okay, that's fine. Here, the current liabilities, like the first thing that I always like to do is I would just be super conservative and I'll be like, oh shit, total current liabilities. Okay, we got $660 million of liabilities. All of this needs to be paid within the next 12 months. That's what current liabilities means. It's happening within the next 12 months. So when you look at all of this, you got to say, okay, well, 660 million, how much cash do I have? Do I have enough cash to survive paying all of this? And you have 3 times that. So that is a good look. You can't go wrong with that. Now, if you look at the deferred revenues, you realize, oh, okay, wait a minute. Deferred revenues and customer deposits, they're not like real payables, okay? But I always do this as a conservative person. I just go straight to current liabilities and I say, okay, what's the damage? Because let's say Palantir doesn't do the revenues, it doesn't perform the revenues it's supposed to do. It's supposed to give this money back. Same thing for customer deposits. But now if we kind of carve these two out, then we got our accounts payable, 75. You got our accrued liabilities, 150. So you have like 225 of real bills to pay that is coming up within the next 12 months. And you got like 10x that. So they're definitely doing totally fine on a cash point of view. If we look at deferred revenues, though, I do know that management has said that they're trying to shift to a SaaS module. So they're not trying to get money up front from customers, but sometimes it's warranted. And it's warranted in cases where management does build something unique for somebody and the customer pays in full, but management is clearly aware that, the customers can still come back within the next 2 months 2 years and ask for some more work to be done because the product doesn't meet their expectations. So management always sets some money aside. So this could be like support revenues, right? You deliver a turnkey software solution to somebody, and then you say, okay, I'm going to give you 2 years software service support. And then during those 2 years, there's a certain bucket of cash that the client assumes was set aside or was charged separately for that service. So that's what deferred revenue is. So management has it parked because they already got the cash for it, but they can only recognize it in time as they earn that revenue. Customer deposits, this is like straight up customers giving Palantir cash, and you see it is going down. Even when you look at it combined, you see here it's 160 plus 30, so like 190, and last year it was 210 and 80, so it was almost 300. So last year it was 300 in customer deposits, and now it's 200 in customer deposits. Does this mean that management is not doing a good job at increasing revenues and landing deals? No. I think what it means is that management is finally shifting over more to a SaaS module, because that's what customers were asking for. And that's what management also wanted to do, because management didn't want to have these huge liabilities on their balance sheet by getting cash up front from customers and then telling them that yeah, we're going to develop your software in a few years, because typically that's not good business, right? Customers don't want to give cash up front, and it's also not good for management, because management has a huge liability sitting on the balance sheet. So it's good balance sheet management in a way. And is it good business management? I think it is, because most customers do not have that kind of luxury to give up so much cash up front. They want to be able to have that SaaS module and be able to pay as they go. So this is interesting, and it's nice to see that management is shifting towards that module, and the cash balance is still increasing, and the restricted cash has went down. So business is good. Business is good. Operating lease liabilities, I mean, these are operating leases that are on the books. That's fine. Deferred revenues. Last year it was what? 190 plus 50, so 240. This year it's so last year was 240. This year it's about 260. So deferred revenues are still going up. That means that kind of makes sense with the increased customers that Palantir is getting. There are going to be software support services being given to these customers. So when that's being done and you have more and more customers, you do have to recognize the deferred revenue. And there's one way around it, but Palantir hasn't been in the game long enough. But after a few years of experience, Palantir will get a good idea of like, okay, well, how many calls they're going to get, how many troubleshooting episodes they're going to have. And then they can say, okay, well, listen, Mr. Auditor, yes, I did give my customer a 2-year support service, but I'm going to recognize all the revenues related to that now, because experience has shown that the expenses that come from these support services are about 1 month worth of work for one engineer. So I'm going to recognize that cost at the same time right now. And if the auditor is convinced, because you can see historically that that has always been the case, then they'll let it go. And then Palantir can recognize the support service revenues all in one shot, along with the expense that is related to those revenues. So for now, I think they're not doing that because they don't have that exposure yet, and they're still growing on the commercial side. So they don't have that experience to say, well, my deferred revenues are, my expenses related to deferred revenues are ABC. Like, I don't think they can do that in a convincing way. So right now they just have it parked, and I assume they're probably recognizing it with the passage of time. So there's that. Customer deposits, blah, blah, blah. Debt, no debt. Operating lease, non-current, they have 220, so that's still standard. So that's looking really good, okay? Balance sheet is fucking strong. There is no goodwill. I'm so happy there's no goodwill. That's like what you typically see in, I don't know, I feel like goodwill is like a Trojan horse. I'm gonna turn the camera back on for this because you need to see my face. So goodwill is, you know, goodwill is often something that's generated when one company buys another company, okay? So if one company, company A, buys company B, and company B, let's say it's super simple. Company B only has $100 in cash, okay? That's it. That's all they have. But company A is like, yo, company B, yeah, forget company B. They have $100 in cash, but I don't want the cash. I like the employees that are working in company B. They're so smart, you know, they're super smart. So, and they're really hard to get. So I'm just gonna buy company B. And then when I buy company B, yeah, I'm not going to give them $100. I'm not giving the selling shareholders $100. I'm going to give the selling shareholders $1,000. So now company A buys company B for $1,000, but you only have $100 cash on the books. So the $900 excess that you paid, that's called goodwill. And the goodwill will show up on the balance sheet saying, oh yeah, we bought this company, we have goodwill of $900, and that company will be integrated into the overall operations and financial statements of company A now. And the reason why I call company like goodwill bullshit, because like in my scenario, what if that employee dips? If that employee dips and just goes somewhere else, or the employee like gets sick and has to quit or whatever, then that magical goodwill that you were paying for is suddenly not there. And in a normal world, the auditors would catch that and be like, oh yeah, the goodwill, you need to write it off because company A or the operations of company A are totally like negative. The employee's not there, you guys are not making money, so write off this goodwill. But now this gets complicated, right? I painted a super simple picture for you. But imagine if it was 5,000 employees with operations everywhere, and then company A can always argue some kind of BS to say why the goodwill is still justified, and make up these create forecasts and these crazy predictions to justify the value in the goodwill. But I personally do not like goodwill, because if someone else comes to buy company A, they're going to be like, oh yeah, you say you have goodwill, but I just don't feel the same way, and they'll just be like, I'm not going to pay you for that. It's just you overpaid and you played yourself. So goodwill is like typically things that some would say, a rational person would overpay for. There's something in there. There's some kind of magic sauce that can't be identified that you're paying for. And the example of the employee that I gave, people do try to value the labor force and give it a value and say, okay, well, over 3 years it's going to be worth nothing because everyone would have left. But if that calculation can't be done, then it just sits as goodwill. So that's why I don't like goodwill. And I'm happy to see that Palantir's financials don't have any type of bullshit like that. So that is always a plus. All right, I'm going to go straight to financials. Let's keep going. I'm going to turn this off. Another takeaway here, stockholders' equity, okay? This is giving us a lot of details. Stockholder equity. Go to additional paid up capital. Okay, fine. Accumulated other comprehensive loss. Accumulated deficit. $5.4 billion. This is how much the company has lost since its inception. $5.4 billion. So that means since like 2009, $5.4 billion has been injected into this company as an expense, or it was SBC. So existing shareholders experienced that through dilution, but that's how much the company has lost. If you're buying into the company today, you do need to know that the company had his history and it has lost 5.5 billion in shareholder value. That's the way I would look at it. And that's when I say shareholder value, it's a combination of being diluted or actually experiencing cash loss from operations. All right, let's look at the revenues. So I do find it kind of peculiar that they showed the 2019. They showed the 2019 because it's a good trend line. It's actually a great trend line. So revenues, you can see revenues doubled since 2019, and revenues grew 50% since 2020. So it went from 742 to 1.1 to 1.5. So this is very strong. The cost of revenue, it went from 242 to 352 to 339. This is a important difference. I just want to see if I can copy paste this. It would be great if I can. Let me see. Let me see if I can copy paste this so I can do some, you know, fun analysis. All right, so what I did so far for the P&L, I mean, I had the P&L here. It was great. But what I did was I copy pasted it so that we can do a better in-depth analysis. And what I want to show you here is revenues. They've been growing, okay? They've been growing at a good pace. I'm just gonna fix the formatting real quick. So they've been going at a good pace. And what is important to take away is that what else is changing is the way it is growing. It is growing while expenses are going down. So that's a good sign. So if we look at the revenues from 2019, it was 742. And now over 2 years, it doubled to 1.5 billion. So that's why they included a 2-year historical, because they really wanted to show that trend that business is growing really well. Revenues have essentially doubled compared to 2019, and they've almost grew 50% compared to, well, 40% compared to 2020. So this is very good. And at the same time, take a look at the cost of revenues. The cost of revenues in 2019 were 33%, 32% in 2020, but now it's dropping to 22% in 2021, which means margins are growing in a big way. Margins have grown to 78%. It was at 67 before, and now it's at 78 over 2 years. If you look at the different types of spend, this is where I anticipate that sales and marketing is going to increase going forward. But for now, it has stayed more or less the same. I mean, it was 450 in 2019, but it grew to 683 as the business was growing, and I'm sure the company went public. And because of that, there was some SBCs baked in here, but now it's at 614. I expect this number to grow. The R&D, it also went down, but I'm sure it's due to the SBC in prior years. The general admin, this is at 611. It has went down. But overall, the total operating expenses, if you see here, like in the past, it was just ridiculous. They had 1.1 billion of operating expenses, so 145% of revenue. So they clearly were blowing money while the company was not bringing in that much. But then in 2020, it went even higher, and I'm sure that's because there's baked in SBC here because they went public last year. So they were at 1.9 billion compared to the revenues. So that means they were spending in expenses $1.75 for every dollar they were bringing in revenues. So that's ridiculous. But now it's starting to come down. Yes, they had 1.54 billion, but this time they spent 1.6. So they're getting really closer to closing this gap and bringing it down and generating a positive net income. So for now, they still have a loss from operations on a GAAP level. They lost $400 million. Interest income, it's negligible. Other income, this is where all the SPAC investments, the unrealized losses from SPACs, and realized losses from other investments, and unrealized and realized FX gains, and the investment in, and the equity investments that they have, like in Japan, Palantir Japan. So all of that is captured in this $75 million loss. And the total loss is $520 million. And they're expecting to pay 31 million in taxes. Or is that it? 31 million in taxes? Yeah, 31 million in taxes, which is why it gets even worse. So that's what I have for the income statement. The trend is good. Revenues are increasing, the margins are improving, the spend is starting to get more tempered down and starting to match with revenues. I think they're so close to getting a profit gap net income, but the truth is that we don't know what 2022 holds. if the SPAC investments all do terribly in 2022, there's going to be a lot of pressure here on this line. Even if they even if they do this well and they bring this to a positive income from operations level, I do regardless see an impact from this line, from the other income or other expense line because of the SPACs. Now, what is the realistic likelihood that we do have a profitable loss from or a gain or income from operations next year? I think it really depends. It's possible that there's going to be a lot of spend on the sales and marketing side, because we do know from the management discussion or the accompanying remarks that management had that they're going to be increasing sales headcount and there's going to be additional training, and because of that, because of the additional training, this might be going up. I'm hoping that the increased costs for training and additional headcount for sales would be offset by a decrease in SBC, because this year also had a lot of options expiring. This number might be a lot lower, and when it drops, it would get eaten up by the additional administrative and sales expenses, so it might be the same. But we need more clarity in Q1. We'll be able to see that in the Q1 details. This is the consolidated statements of comprehensive loss. So this is just 520 foreign currency translation adjustments. That's when you translate financial statements from other countries back to USD. So there's a foreign currency translation gains or losses. Now let's look at the consolidated statement of redeemable and convertible preferred stock and stockholders equity, or deficit if it's a negative. So here we start at December 31st, 2018. They bring us to December 31st, 2019. So here, and this I think is super important for people to realize, is here you realize, look, they had 742 million preferred stock, 25 million preferred stock, 549 common shares, and then they ended at 2019 with 581 million common shares. So they still didn't hit the 2 billion mark. You know, right now they have about 2 billion shares outstanding, but here they have 580 million. But then in 2019, it goes from 580 million to convertible of preferred stock. So all the preferred stock is gone. Preferred stock becomes common shares. So the 581 with the 793 and with some share issuances, they get to 1.79 billion shares. So about 1.8 billion shares by the end of December 31st, 2020. Then from 1.8 in December 31st, 2020, where do we go? We keep adding. See, look, these fields are gone now because they're all gone. They're done. See, it ends with 0. So now we're just with this, the common stock. So now in common stock, from the 1.79, which is how they ended December 31st, 2020, they issued more shares from stock options. So this is what went into the market. So 179 million shares were brought into the market. RSUs, 50 million. So, you know, growth units. So the total 178, 50. So let's say 180, 230. About 230 million shares were brought into the market, and it put pressure on the stock price, you know, during 2020. Then we ended at 2 billion shares outstanding. So that's why when people remember the crazy run up back in the day, it was because a lot of shares were not in circulation. You know, they were subject to a holding period, and then they were allowed to be sold. And a lot more were introduced into the market in the current year for tax purposes. So now we have 2 billion shares outstanding, common shares. Just a lot. Now, this is my favorite statement. The statement of consolidated cash flows. Here, we really need to realize some of the amazing things that Palantir is doing. This is the net loss, okay? This is what we saw on the financial statements, the profit and the income statement. What we're doing now is we know that in this P&L, in this income statement, in this number, there's a lot of accounting entries. So accounting entries that don't have any cash impact on the company. So all of these accounting entries that don't have a cash impact have to be removed. So this is where we start seeing some action. So example, depreciation. This is an accounting entry, okay? Just because we say we own a car or we own machines or software or equipment and we lost 15 million for accounting purposes, depreciation, there wasn't actually 15 million cash being lost. So you remove that. Stock-based compensation. There wasn't 778 million in cash being issued by the company. It was just stock-based compensation. There is no cash impact. So you see, it's 778 million right now. The net loss is 520. If for whatever reason they just completely eliminated the stock-based compensation, we would have a gap net income right away, instant. 228 million, 200 million gap net income, easy. But we don't, because we do have stock-based compensation. Then there's other adjustments, but the key takeaway is net cash provided by operating activities. The year in 2021, they went from losing 165 million in cash to 300 million in cash to now making 300 million in cash. So they recovered from losing 300 million and they made 300 million more. So the gap here is 600 million. They were able to improve cash flow from operations by 600 million year over year, which is huge. Last year's stock-based compensation was almost 1.3 billion. Now it's 800 million. So it's going down, and I'm looking forward to it normalizing. Investing activities. This is things that the company does on the side, which is considered investing. So buying SPACs, buying equipment, making investments in other countries to start a new Palantir operation or joint venture. So this is where we see some of that details. So we see here that they spend 400 million in investing activities. This should not be looked at as money gone down the drain unless they're blowing money on dumb stuff, which they're not. So here we see the gold bars, 51 million. Here we see the SPAC investments, 310 million about. Here we see them buy equipment. It's been more or less the same. Here they bought a private company, 23 million. It would be nice for them to start showing some returns or some gains from these investments. But then again, that would be a bit short-sighted of me, right? To ask them for that because they just made these investments. Palantir is not a day trading company. So there's that. Now financing activities. So this is all the activities related to financing, issuing shares, and this, that, and the other. So here we see proceeds from the exercise of common stock options. So, I know people are mad that the company is issuing shares, blah, 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 through stock options, but it's still generating money, cash flow into the treasury of the company. So in 2021, because they had issued so many stock options that were expiring and were going to be exercised, the company brought in $507 million. In the prior year, it was about 300 million. Principal payments on borrowings. They paid off all their debts. They paid 150, 400, and now 200. There's no debts on their books. The net impact of that was 300 million. So although the company generated 300 million from operations, and then they invested 400 million, so I wouldn't say this is money gone down the drain. 300 million plus the proceeds from stock options after paying debt, the company technically would have had $600 million in cash flow from total activities if they didn't do any of the SPAC investments. But it looks like they're doing the SPAC investments because some of these companies are super innovative and they do have the potential to be huge disruptors. So that's that. That's how we went from 2.1 billion last year to 2.366. That's the cash flow. And here they do give some additional information. They talk about cash paid for income taxes, cash paid for interest. That's great. And then here they say supplemental of non-cash information. They talk about how in prior year they had some impacts. All right, so Now we're going to be getting into the notes of the financial statements. This is kind of dry material, but the hidden gems are always in this section. So pay attention while I run through it. I'm going to bring them out, and let's see what we can find in these notes. So let's get started. So let's go through the notes of the financials. Not much to mention here. They're just talking about basis of presentation. So US GAAP, you know, that's the good stuff. Direct listing, company went public on the 30th of September. Okay, great. Use of estimates here and there. The chief operating decision maker is the chief executive officer, and it just says like, okay, well, how does he evaluate the business? He evaluates the business based on commercial and government. So there's two businesses, commercial and government businesses. That's how he looks at it. So that's how Alex Karp looks at the business. Okay, great. Cash and restricted cash. The company considers all highly liquid investments purchased with original maturity of 3 months or less to be cash equivalents. Restricted cash primarily consists of cash and certificates of deposit that are held as collateral against letters of credit and guarantees that the company is required to maintain for operating lease agreements, certain customer contracts, because, you know, if Palantir messes up, they can take that money, and other guarantees and financing arrangements. All right, so this is where we have breakdown. So you see they got about 2.3 billion. They have about 40 million and 40 million in restricted cash, long and short term. So in total, they have about 2.4 billion in cash. AR and allowance for receivable losses, allowance for credit losses. AR is recorded at the invoice amount, net of allowance for credit losses, if any. As of December 31st, 2021 and 2020, Palantir did not record an allowance for credit losses, as probable losses are not expected to be material. So no losses. They don't expect any major losses from clients not paying. So that's good. This is a area of interest as time goes on, where people say, well, what about them specs? What about them specs? Are they going to be able to pay? Or are they going to be burning money and not be able to pay what they owe Palantir? And the thing is, as Palantir becomes more and more important and integrated to these operations as their main data operating system to do what they need to do, Palantir would probably be the first to get paid, right? So I wouldn't stress out about that, but it is a risk. Concentration of risk. Financial instruments that potentially subject the company to significant concentrations of credit risk. Blah, 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 blah. Okay, so the company is exposed to these concentrations of credit risk. The company's AR balance of 190 and 156 respectively over the 2 years. Not one customer represented more than 10%. So that's good. So they're not highly dependent on any one customer. Customer G represented 13% of total AR as of December 31st, 2020, but not in 2021. No other customer represented more than 10% of AR as of December 31st, 2020. Okay, great. For the year ended December 31st, 2021, no single customer represented 10% or more of total revenue. So this is, again, people saying Palantir being too dependent on any customer. Not true. There's not one customer that represents more than 10%, but obviously if you break down the US government, then clearly, you know, and you look at it as a one entity, then you know the US government is important. So here, December 31st, 2020, customer F, which is in the government operating segment last year, represented 10%. And then 2019, customer D, 12%. All right. Alternative investments, gold bars. Alternative investments include gold bars and are recorded in prepaid expenses and other current assets on the consolidated balance sheet. The investments are initially recorded at cost and subsequently remeasured at the lower of cost or market each reporting period. Market value is determined by quarter prices. Okay, so they said prepaid expenses, 50 mil. So, you know, we saw it here where they dropped that cash, right? So we saw purchases of alternative investments, 50 mil. That was the cash that was spent to buy the gold, but on the balance sheet, they're saying that it's actually in the prepaids. Interesting. So it's sitting in here. not here. So marketable securities are just the SPACs, and the prepaid expenses are includes the gold. So the lift of 50 million year over year is because of the gold. Okay. So that is interesting. That is something that was buried in the details. Great. PP&E. PP&E is more or less the same. Straight line method over 3 years. Okay, so whatever they're buying, they burn it down in 3 years as depreciation. Leasehold improvements, so any upgrades to the offices are straight lined 5 years. Leasehold improvements 5 years, anything else 3 years. Equity method investment, so this is when the company owns between 20 to 50%, because anything over 50% is considered control. Anything less than 20% is just considered significant influence, if anything. Not even significant influence, it's just an equity investment, so it would be just treated as what we saw above, a marketable security. But here they have some equity investments, so they say they have direct or indirect. Okay, so to evaluate, the company first considers if they have direct or indirect control. The company adjusts the carrying value of its investments by its proportionate share of the net earnings or losses. So that's what we saw being buried in the unrealized losses. So unrealized profits or losses or intra-entity transactions. So they make adjustments for that. So any intra-entity transactions, impairment charges, blah, blah, blah. Company's proportionate share is reflected in other income. There you go. That's where we talk about it. All right. Privately held securities, equity securities in private held companies without readily determinable fair values. Okay, because they're private. So it's just measured at cost, I imagine. Such investments are carried at cost. Okay, great. Impairment of long-lived assets. Long-lived assets are reviewed for impairment annually. Yeah, okay, nothing new there. This, lot of fluff, nothing good there. Fair value, yeah, nothing there. Revenue rec, this is what we talked about before. Here they talk about their different products. So the Palantir Cloud, where they give customers rights to access the software functionality in a hosted environment controlled by Palantir and sold together with their operations and maintenance services. There's that. On-premise software, so this is software that's installed at the customer's premises, I imagine. Professional services, contract liabilities. Deferred revenue represents billings under non-cancelable contracts before the related product or service is transferred to the customer. Customer deposits consist of refundable payments received in advance of the start of the contractual term or for anticipated revenue generating activities that is subject to cancellation. Many of the company's arrangements include terms that allow the customer to terminate the contract for convenience and receive a pro rata refund of the amount of the customer deposit for the period of time remaining in the contract. That's what's kind of scary, right? It's not like lockdown. Like they give the customers the comfort of the doubt and say, yeah, you can cancel whenever you want, which is a big move. Very risky because other people say, too bad, so sad. So, you know, Palantir is investing its time into developing solutions for the customer, then enters into a contract with the customer. And then on top of that, the customer has the chance to just walk away at any time. That is like trying to give them a really, really good deal to see the value. That's how confident Palantir is. They're so confident that the customer will like the product, will enjoy it, and see the benefits that they would not cancel. And, you know, some people could see this as a bearish view, you know, like, what if everybody just dips overnight? But then again, you know, contracts, in my opinion, I've seen contracts that were supposed to be bulletproof, and then when the market crashed and such company was supposed to buy X amount of barrels of oil at this price, and then they said, go fuck yourself, I'm not paying that much anymore, I'm going to only give you this. And then the company selling the oil agreed. You know, they're like, okay, fine. You know, we don't want to lose your business, so we'll adjust our price. Even if they could have tried to enforce it contractually, it would have been dragged through court. Company's payment terms are 30 to 60 days, which is good. Areas of judgment. Yeah, so there's a lot of judgment here. And it's what I talked about before, separating components of revenues. Costs to obtain and fulfill contracts. So costs to obtain include acquisition contracts, sales commissions. The company recognizes a contract cost asset for the incremental cost of obtaining a contract with the customer if it is expected that the economic benefit and amortization period will be longer than 1 year. Costs to obtain contracts were not material. Company recognizes an asset for a cost to fulfill a contract with the customer if the costs are specifically identifiable and are expected to be recovered. Costs to fulfill contracts were not material. Okay. Software development costs. The company evaluates capitalization of certain software development costs subsequent to the establishment of technical feasibility. Based on the company's product development process and substantial development risks, technical feasibility is established for the company products when they are made available for general release. Accordingly, the company has charged all costs to research and development expense in the period incurred. So this is where a lot of people hate GAAP for being so strict, because GAAP really requires you to define and clearly demonstrate that the product you're developing is commercially viable. And if it's not commercially viable, or you can't prove it yet because you don't have a customer, then the auditors have a hard time saying, okay, well, park those development costs as a asset. And if you can't convince the auditors to do it, then you just have to capture all of them in the P&L. And that's just the way it is. When people are buying companies out, though, they consider R&D an asset, and they would say, acquiring new knowledge, regardless, you're learning something new, regardless, you're realizing, okay, A method works or A method doesn't work, so let's try B method. There's still learning happening, learning and growth, and all of that is kind of an asset which could provide value to the company for the next 2-3 years. So when people are buying companies or evaluating companies, they would sometimes tend to capitalize this R&D and then burn it down as an amortization over 3 years, as opposed to just taking what's in the financials and assuming that, okay, R&D is just a P&L, goes, where it's an expense, because it could be an asset. But it's all about perspective. But US GAAP and all the other accounting standards like IFRS and accounting standards for private enterprises in Canada, they're pretty they have a framework, and they want people to be consistent from one company to the next, so everybody has to follow similar rules to be comparable. Cost of revenue includes salaries, stock-based compensation, and benefits for personnel involved performing ops and maintenance and professional services, as well as third-party cloud hosting services, allocated overhead, and other direct costs. Sales and marketing includes salary, SBC. The company generally charges all such costs to sales and marketing in the period incurred. Advertising costs are expensed as incurred and included in sales and marketing. Advertising expenses totaled 26 million. It was immaterial for the prior years, so it started to get important. Wow. This must be like all the promo videos, all the ad space that they put on the paper. So it adds up. Research and development. R&D includes salaries, SBC, limits and contingencies. Nothing new here. All right. So let's keep going. Stock-based compensation is going to be a lot of good details in here, so let's pay attention. So there's 3 types of stock-based compensation, right? Service-based vesting. So that's generally when, someone earns their service, performs what they're supposed to do, and then their stock options are exercised. And in this case, it's usually just someone working for a certain amount of time. So the company records stock-based compensation for stock options are RSUs that vests only based upon satisfaction of a service condition on a straight line basis over the requisite service period. So generally 4 years. So they're saying stock-based comps, RSUs, restricted stock units, vest over 4 years in general on average. So while it's being earned, they book the expense. Okay, great. Performance-based, that's when it's performance-based, when they hit a certain goal. Great. Employee benefit plan, they sponsor a 401k for their employees. The company may make additional matching contributions, but they did not make contributions in 21, 20, and 19. So stock-based compensation is the way to go for Palantir, it seems like. Income taxes, it's typical income tax rules and how they recognize their assets. Net loss, yeah. The rights, including the liquidation of the holders of Class A, B, F, A, B, and F, collectively the common stock. Okay, so A, B, and F, so all special shares are part of the calculation. Foreign currency, US dollars, that's what they translate into. Okay, great. Recently adopted accounting rules. Okay, for simplifying income taxes, fine. Contract liabilities. The company's contract liabilities consist of deferred revenues and customer deposits. As of December 31st in 2020, 463 mil, 531 mil combined. Revenue of 378 and 477 was recognized during the years ended December 2021 and 2020 respectively. That was included in contract liability balances as of December 31st, 2020 and 2019. So what they're telling us here is last year's balance of 531, they recognized 378. That is a substantial amount. And 477 from the 2019 period, which they didn't give us. Remaining performance obligations. The company's arrangements with customers often have terms over multiple years. But the company allows customers to terminate contracts for convenience prior to the end of the stated term with less than 12 months notice. With less than 12 months. So that means, yeah, anytime. Company's remaining performance obligations was 1.1. The company expects to recognize 42% of that over the next 12 months. Okay, wow. So 0.42. So they know for a fact that they're going to get recognized 460 million next year from this 1.1 unless customers cancel. Segregation of revenues. Okay, so they say go to note 14. Note 4, investments and fair value measurements, money market, certificate deposits. Okay, great. Nothing crazy here. Okay, wait, investments, marketable securities, 234. Yeah, that was level 1. It was because it was on the stock market. Okay, great. Investments. During the company approved and certain agreements, that's what they call investment agreements. In connection with signing investment agreements, each investee or an associated entity and the company entered into a commercial contract for access to the company's products and services. The total value of such commercial contracts was 767 million. Total value of such commercial contracts was 767 as of December 31st, which is inclusive of 116 million of contractual options. Okay, from the investment agreements. Let me see if that's changed based on what I've documented in the past. In the past, we said it was 640 million for investment agreements. So the 640 million for the investment agreements were these ones that we really knew about, and the others were like these ones in light shaded gray. They were from the 13F. So this we knew happened after Q3. But these investment agreements as of Q3 called for 640 million. But now as of December 31st, we have these in there as well, as of Q4 or as a subsequent event. So these are all the SPACs now. And all of this combined, they're saying that it's 768. Okay. And they're going to probably get into details. The terms of such contracts, including options, are from 3 to 10 years. During 2021, the company assessed the concurrent agreements under the non-monetary guidance, revenue from contracts with customers, as well as commercial substance of each arrangement. Okay. The total revenue recognized from these commercial contracts during the year ended December 31st was 49 million or 48 million, my bad. Okay, so there's investment agreements with all of these companies. The Hyundai Oil Bank, okay. So, Palantir did invest 20 million in Hyundai Oil Bank. Alternative investments during the year end, yep, 51 million of gold bars. We know about that. Accrued liabilities, there you go. Payroll and other accrued liabilities. They don't really say what this is. Equity method investments, Palantir Technologies, Japan. We knew about this. Debt paid off. Leases, operating these commitments, less sublease income. So it cost them 260. They're planning to get 132 from whatever space they subleased to others. for net 127. Okay. Palantir becoming a little real estate company there. The weighted average remaining lease term related to the company's operating lease liabilities, 6.9 and 8.1. Purchase commitments. This definitely has to be related to Apollo and Palantir Cloud. Let's look at it. December 2019, company entered into a minimal annual commitment to purchase cloud hosting services of at least 1.5 billion over 6 years, with an optional carryover period to 2029 in exchange for various discounts on such services. So they're getting a really good price on these services, but they entered into a fixed deal. Okay, investment commitments. This is key. This is going to show us a bit of a more insight as to where Palantir is investing and where they've committed to invest, but it hasn't been finalized yet. So let's look at this. So as of December 2021, the company had outstanding investment commitments subject to the terms and conditions to purchase 13.5 million shares for $135 million. Okay. So about $10 a piece. Wow, man, this is a bit intense. Like Palantir has a lot of investment agreements. So let me add in Rubicon Technologies here to my summary. This is a big investment, similar to Wejo and Babylon Health, 35 million. Interesting. Right, so that's that. Warranties and indemnification. The company generally provides a warranty for its software products and services. The company's performance for a period of 90 days. 3-month warranty. That's insane. Stock-based compensation expenses. So here they talk about how it was split amongst the employees, and as you can see, the administrative team, the management team does get a good chunk, 300 million, 375, whereas before in 2019, everyone was pretty much equal. So you do see management taking big rewards in the last 2 years. Almost 700 million. The R&D team took in 450, 460. The sales team took in about 650, and the production team or manufacturing team working directly on projects took about 200. That's very interesting. Income taxes. Okay, United States. They have a provision or a benefit, so they think they'll get back a return. Okay, great. States always love taking money. A reconciliation of expected tax provision. That's fine. We don't need to get into this. Okay, net loss per share. There you go. They break down. Okay, the net loss, total number of shares. This is how you get it. Basic, diluted. Fine. There you go. Here it is. The following outstanding potentially dilute common stock. Here we go. This is what we're talking about. Options and SARs issued and outstanding. 349. So about 350. So this is options and SAR. Then this is the RSU. Warrants 13042. Okay. All right, so now we're looking at the segment and geographic information. In here, what can we learn? What we see here, just quickly observing, is revenues almost doubled, right? Government revenues more than doubled over 2 years, right? And commercial revenues are growing at 50%. So 2 years ago it was 400 million, and now it's 600, so at least 50%. Here they were almost at 500 million. Here they're at like 6.5. So it's not a big growth. It's about 10. No, not 10, but 3%. 10% of 500 would be 50. So yeah, about 30%. So yeah, about 30%, let's say, more or less. So it is going in the right direction, given the number of headcount that they have. When we looked at the accompanying remarks, I think we saw that the number was 25 experienced headcount in commercial sales at the end of the year. So it's growing. It's going in the right direction. contributions. So the contribution margin is quite substantial. You could see the huge growth here. It's been improving 21 to 58. How do they get to these numbers? They say, okay, start from the loss, right? Because that's the accounting loss. Add back the R&D, add back the G&A, and then you get the total, and then you have to add back the total stock compensation, and then you get to 899. So they're saying that these expenses need to be added, need to be removed to show the total contribution from the projects and what they're bringing to the table, because they say the management expenses have nothing to do with it, and R&D have nothing to do with these numbers. So from the business, the revenue generating business, they're getting almost 900 million. Very good. Geographic info, right? So UK, France, United States, top 3 priorities. Overall, these 3 are generating a substantial amount of the revenues for the company. But is it 75% almost? 68 plus 6, yeah, about 75%, and 25% is coming from the rest of the world. And this seems to be more or less in line with what's been happening in the past. You know, the rest of the world was always 25%. So revenues in the US is growing. Revenues in the UK dropped a little bit, but in percentage points, the total, but the total dollars has been growing. Same thing here. Total dollars has been growing a bit down last year, but it's still heading in the right direction. You know, as the numbers grow bigger and bigger, the denominator gets bigger and bigger. So growth is harder to achieve. Now, PP&E across the world, the PP&E impacts, there's about 19 million in the US, 8 in the UK, 4.2 the rest of the world. I imagine this would be Japan, Switzerland, and wherever else they might have some satellite offices. Subsequent events. Okay, so here they say, okay, well, from January 1st, 2022 to the date of the financials, these deals went through. Fantastic. So now that we reviewed the financials, I think the key takeaways are, first, let's look at dilution, because it's always a hot topic. Expected dilution is expected to be between 4 to 5% over the next 3 years. That's assuming that all these RSUs and options are exercised. If they're not exercised and they're just forfeited or canceled, then the dilution on the existing shares would be a lot less. Right now, the way I calculated it is, obviously I took class A, B, and F together as of December 31st, which gives us about 2 billion shares, 2 billion and 27 million shares. And then if they're exercised at this manner, then we would expect a dilution of 4 to 5% over the 3 years. But this is a worst case scenario based on what we know right now. It is possible that none of these do get exercised, or half of them get exercised, or some of them are forfeited. And it's also possible that management revamps these programs during the year and changes things up entirely because they want to keep employees in the company. Now, another thing to take away is that if these things are being exercised, these options are being exercised, then clearly there's going to be a cash inflow, a significant cash inflow. Big money, though, if these shares are exercised and they become real shares, if these options are exercised and they become real shares, we can expect cash inflows of 720 million each year. Now, the financials, I mean, the gross profits are heading in the right direction. GAAP gross profits, 78% in 2021. It's a significant growth, which is pretty strong as the dilution comes under control, as share-based compensation becomes under control. This is going to have a positive impact. If you look at stock-based compensation, it was 800 million. It was 1.3 billion last year, 800 million this year, and I'm expecting it to be 400 million next year based on what we have. So 400 million in SBC is a positive estimate, but it really depends on what actually ends up happening. So let's just say the stock-based compensation is 400 million next year instead of 700 million. Assume everything else stays the same and SBC was 400 million less, then we would be at a 100 million net loss position. Let me do a pro forma to not throw anyone off here. But let's say, look, this times 1.3. This is management's guidance, right? So they're going to say they're going to hit 2 billion next year. Okay, fantastic. Now, we would say sales and marketing would be that. This would be that. Following the same baselines that we had before. Now, total operating expenses would be what? It would be this plus this plus that. $2 billion. Are you serious? Are you serious? Yeah, so $2 billion because it was always a bit higher than revenue. But now it's because there's share-based compensation. And you know, we saw in the financials, share-based compensation was 800 million here, but I'm estimating that it would be 400 million here. So we're going to reduce, and you know that 800 million, it's buried in these different amounts. It's hidden in here, okay? It's hidden here, here, and also the cost of revenues. So what I'm going to do now is I'm going to flex this, and I'm going to minus the 400 million because SBC is not going to run at the same level. So now we're at a 1.7 billion total OPEX. So then the loss from operations, it still would not be enough. We would still have lost 134 million next year. And let's say, you know, this is like, I don't know, let's say SPACs suck next year. So it would be like 150 million. Then the total loss of net income would be this, 284. So the path to profitability actually would not be possible next year. It would be highly unlikely now that I think about it, because even if we follow the same rates, the same percentages, and we added back 400 million for SBC that's going to be removed, we would still be in a loss position from operations. So the only way this would ever improve is if management can tweak this and get gross margins to like 85%. If they could do that, then this number could maybe, let's say 85, then it would go down to 150 million. So they would have to be like 90%. Would they be able to pull it off then? Yeah, you see here, net loss is 40. They did 85. No, they would have to have like 95% gross margin on the revenues, which is highly unlikely for the next little while. So I would say, you know, let's keep monitoring. And also, you know, there is indication that the sales prices might be going up too, right? The sales and marketing costs, because they are training a lot of employees, and it takes about a year for employees to get comfortable in selling big contracts. So I don't think we will see profitability in 2022, but I do see us getting there, getting very close to it, or at least cutting this amount in half. So let's see what happens. It's very possible that, you know, I'm totally wrong here, and we could have some surprises, but I would say be patient. We will see some surprises soon. And obviously I was being very conservative here. Let's say these companies do have big gains. Then obviously if the company does the same thing, but it does 85, then you see we're at a net income position. So anything can happen, but there's too many variables to really control this. So that's one of my takeaways for the financials. Another one would be the investment agreements, but I'm sure everyone has beat this to a pulp. But clearly Palantir has invested now $326 million in solid deals that have been confirmed, that are done. And then add to that 326, we have another few 134 that these are commitments. 400, at least 450 million in investment agreements. So that's a big takeaway. Palantir has almost close to $500 million now in investment agreements, which I find is very aggressive. But if 2 or 3 do become super valuable and do generate a huge value for Palantir, then it could be a big win. If you haven't really seen my SPAC videos, I mean, I've been doing summaries and evaluating each company and concluding if it was a good deal or not. So definitely take time to check that out. I'll put the link in my to my playlist, and you can get more details than that. All right, so that's it for me, guys. Thank you for listening, and I will see